Your 401k plan might have a feature that lets you contribute way more than the $23,500 per year amount and convert it all to a tax-free Roth account. Many large company plans have this feature, but most employees have no idea that it exists. The gap between what most high earners think they can contribute to retirement accounts and what they actually may contribute can be enormous. I'm talking about potentially $40,000 per year in additional tax-free savings that most people are missing. What I'm talking about today is the Mega Backdoor Roth account. This is within 401k plans, and if you've never heard of it, you're not alone. Here's what we're covering today. First, I'll reveal exactly what this elusive Mega Backdoor Roth is and why it's so ridiculously powerful that it can potentially double your retirement savings capacity. Then, we'll dive into specific requirements because, spoiler alert, not everyone can do this, and the restrictions might surprise you. And finally, we'll tackle the big question. Is this legitimate tax planning or just another way the wealthy game the system? By the end of this video, you'll understand one of the most powerful retirement strategies available today and know exactly how to determine if you can use it. So here's where most people get completely fooled by the system. Everyone thinks that they understand the 401k limits, anywhere between $23,500 for individuals in 2025 or $31,000 if you're over 50. For some individuals starting in 2026, that catch-up contribution actually is going to be forced to go into a Roth account. But we think that it ends there. That's what the vast majority of us believe. But that's not the actual real limit. The total amount that can go into your 401k, and I mean everything, your contributions, your employer match, profit sharing, and after-tax contributions, the whole 9 yards, is actually closer to $70,000. If you're under 50, or $77,500 if you're over 50. Now, most people will hear this and think that the gap between $23,500 and that $70,000 amount for those under 50, assume it's just for the employer contributions. But that's where they're wrong. And that's where the Mega Backdoor Roth 401k comes in. This account lets you make after-tax contributions to fill up that remaining space. Then immediately, ideally, convert those dollars to a Roth bucket, either within your 401k or by rolling them over to a Roth IRA. This type of plan completely breaks through those income barriers that normal IRAs would shut out high earners from contributing more to a Roth account. It's like finding a secret door in the tax code and similar to a backdoor Roth IRA. Link in the description for more on that. Now, in order to make direct Roth IRA contributions, it's off limits if you're over a certain income as an individual filer or even a joint filer. Traditional IRA contributions, those deductions actually phase out much lower level of income. But the Mega Backdoor Roth, there is no income limits whatsoever. None. It doesn't matter if you make $200,000 or $2 million. So to put this into perspective, if you're already maxing out your regular 401k and doing the backdoor Roth IRA, you might be saving around $30,500 a year in tax-advantaged accounts. That's pretty solid, but with the Mega Backdoor Roth, you could potentially more than double that. So here's what this might look like over a long period of time. Someone converting $47,000 annually through this strategy over 20 years, assuming even modest 7% growth, could end up with over $2.3 million in tax-free Roth wealth. Of course, this is illustrative, but it is helpful to illustrate the concept. And unlike most traditional retirement accounts that force you to start taking distributions when you're in your mid-70s, this Roth money can stay invested and growing tax-free. Now, here's where reality sets in and we can identify whether or not we have access to this type of account. Your employer's 401k plan must allow for two very specific features. This is a make or break factor. First, your plan has to allow for after-tax contributions. And I'm not talking about Roth contributions. Those are completely different. I'm talking about true after-tax contributions that go beyond normal deferrals. Second, your plan needs to allow for either in-service distributions or in-plan Roth conversions. Without this, you can make the after-tax contributions, but you can't get them converted to the Roth account, which defeats a lot of the purpose of the tax-free growth. Companies like Apple, Google, Salesforce, larger companies, they tend to have plans that support this. But I've studied plenty of the plans of other larger companies where these features just don't exist. In my research, maybe 20% of the large employer plans have the features you need. So you might be out of luck through no fault of your own. You can find out by checking your plan's summary plan description. That's the document that explains your 401k plan rules. Or ask your benefits administrator and ask specifically about after-tax contributions and in-service distributions. If your plan does qualify, here's exactly how to make this work, and I'm going to give you the details that can make or break this entire strategy. So pay attention, the details matter enormously here. Step number 1 would be max out your regular 401k contributions first. This means either the full $23,500 in either pre-tax or Roth deferrals, or $31,000 if you're 50 or older. Don't skip this step. It's the foundation. Step number 2 would be calculate your available space that's left over after your employer match or profit sharing that you're getting. Take that $70,000 annual limit, subtract your employee contributions, profit sharing. Whatever's left is what you can contribute as after-tax dollars. So walking through a real-world example, somebody who contributes $23,500 in regular deferrals and gets $15,000 through employer match has $31,500 under the age of 50 in space for after-tax contributions. That's $31,500 that they can convert to tax-free Roth growth. Step number 3. Set up the after-tax contributions through your payroll system. This usually requires a separate form or election, and honestly, a lot of HR departments aren't familiar with this process, but the custodian who holds your 401k funds should be. You might need to educate your HR on your own plan if that is the case who you're going through. But most of the 401k providers, if you call them, they'll be able to help facilitate this. Step number 4 is you need a conversion strategy, and timing is everything here. And you've got 2 options, and the timing matters. Option A is if your plan allows for in-plan Roth conversions, you can try to set up automatic conversions so that your after-tax contributions are immediately moved to the Roth portion of your 401k. This is usually the cleaner approach. You set it and forget it. Option B would be if your plan allows in-service distributions, you'll periodically log in and roll your after-tax contributions, not the earnings, to a Roth IRA. The key here is speed. Why does that matter so much? Because the longer that your after-tax contributions sit unconverted, the more earnings they'll generate. And here's the kicker. While your original after-tax contributions convert tax-free, any earnings on those contributions, if they move into a Roth account, that's when they become taxable as ordinary income when you convert them. So if you can contribute $10,000 in after-tax money and it grows to $10,500 before the conversion, the $10,000 converts tax-free, but you'll owe ordinary income tax on that $500 in earnings. And this is why the speed matters so much. Now let's talk about pitfalls that might occur if things go sideways. The first pitfall might be the pro rata rule. And now this is something that's important, and the rule typically actually doesn't apply to Mega Backdoor Roth conversions, unlike their cousin Backdoor Roth IRAs, as long as your 401k maintains a separate accounting for after-tax contributions. Most plans do this, it's just important to confirm. But if you're doing regular Backdoor Roth IRA conversions and having the traditional IRA balances as well, that's where the pro rata rule can create issues with the conversion dollars. The second issue is the earnings on the after-tax contribution, which we talked about. This is the one that catches people off guard. So remember what I just explained. Any of that growth on the after-tax becomes taxable ordinary income when converted. Conversely, you can always end up rolling the earnings into a traditional bucket account in the future since, well, ultimately that has not been taxed and it's something that you can escape, but then you lose the tax-free growth. I've seen cases where someone's $40,000 after-tax contribution grows to $42,000 over 6 months and they owe taxes on the $2,000 amount at their marginal top tax bracket. So if they're in their 32% tax bracket, that's $640 in unexpected federal taxes alone. Forget about state, that's added on top too. Third issue would be non-discrimination testing. Your employer's plan has to pass certain tests to make sure that it's not just benefiting highly compensated employees. If the plan fails these tests, you might see excess contributions refunded in the new year, which completely disrupts this strategy. Your perfect plan can get blown up by other people's behavior. And now there's something that most people don't think about, which is legislative risk. Tax laws change, and strategies that work today might be limited or eliminated tomorrow. There's been a lot of changes in tax law lately. There was at some point talk about removing the ability to do the backdoor Roth IRA contribution strategy. So there's always a discussion about closing these types of planning opportunities. Congress could shut this down tomorrow. And this brings up the big question I always get is this a legitimate strategy or just another way that the wealthy game the system? Now, this strategy is completely legal under current tax law. Congress created these rules, and using them as intended is not cheating, it's smart planning. But I'll be completely honest with you about what I've observed. This strategy absolutely benefits high-income earners disproportionately. That's just the reality. You need to work for an employer with a plan that supports it. You need the cash flow to make substantial additional contributions, and you probably need to understand more complex strategies. Is that fair? That's a policy question, but it's the reality that we're working with under current tax law. And this is not just available to individuals that are employees. This is also available to those that are contractors or self-employed individuals who structure things like a solo 401k for their own benefit in a way that they can potentially do this for themselves and a spouse to sock away up to $140,000 into their retirement plan if their self-employed income is enough. Now, who should consider this strategy? Based on the analysis of different income scenarios and financial situations, this is a strategy that makes the most sense for high-income earners who have already maxed out other retirement savings options and have sufficient cash flow to fund significant additional contributions. So I'm talking about people who are higher earners and even those who have a large bonus or a large income in a certain year that have excess. So these could be individuals who want to balance their tax exposure. But here's what I always emphasize. If you're struggling to fund an emergency savings or pay down high interest debt, this strategy is simply just not for you. Follow the financial fundamentals first, build your foundation before implementing advanced strategies like this. The Mega Backdoor Roth 401k represents one of the most powerful planning strategies available today. Is it a hack? Yes, in the sense that it's a clever use of the existing tax rules. Is it a cheat code? No, it's completely legal when executed properly. Remember, knowledge is only powerful if you act on it. This strategy isn't going to implement itself, but once you get the piping and structure in place, and for those who can use it, it could be the difference between a good retirement and an extraordinary one. Thanks for watching, and I'll see you in the next one.